Investors beware, these stocks could get crushed by tariffs. Hey, what's up everybody? It's Modern Money Solutions, and today we're talking about Trump's tariffs. These things are no joke, and they have the potential to seriously mess with some major companies. The stock market hates uncertainty, and when you start slapping huge tariffs on imports from places like Canada, Mexico, and China, yeah, that's instant uncertainty. We're talking 25% on goods from Canada and Mexico, and an extra 10% on stuff from China. That's gonna add up fast. Let's dive in. First up, we gotta talk about the American icon itself, Ford Motor Company. This is a brand that has been synonymous with American ingenuity and manufacturing for over a century. Ford is about as American as apple pie, right? It's a staple in American culture, representing the spirit of hard work and innovation. Well, here's the thing. A lot of the parts that go into those iconic F-150s and Mustangs, they aren't all made in the USA. Yeah, they come from Canada and Mexico. These cross-border supply chains are crucial for keeping production costs down and efficiency up. And with these new 25% tariffs, oof, those production costs are about to go through the roof. The tariffs are hitting raw materials like steel and aluminum hard. All these components are now going to be significantly more expensive. With those materials becoming a lot more expensive all of a sudden, Fords will have to figure out what to do. They need to strategize quickly to mitigate these rising costs. They could eat the cost, but that's going to hurt their profits, and Wall Street hates when profits shrink. Investors are always looking for growth, not losses. Or they could raise prices, which is most likely, but guess what? Nobody wants to pay more for a car, especially in this economy. Higher prices could drive customers away. Think about it. People are already feeling squeezed from inflation, even though it had been improving, and now you want them to shell out an extra couple grand for a new truck? It's a tough pill to swallow. It's a tough sell, and Ford knows it. They understand the delicate balance between pricing and customer satisfaction. Now Ford's not stupid. They're already looking at ways to adjust their supply chain, maybe even source more parts domestically. This could be a long-term solution to avoid future tariff impacts, but for the immediate future, it's going to be tough. If you're holding Ford stock, you need to watch this situation closely. The company's next moves could significantly impact their financial health, stock performance, and even your wallet. Next up, let's talk about another big player in the auto industry, General Motors. Just like Ford, GM relies heavily on parts from Canada and Mexico. We're talking engines, transmissions, the whole 9 yards, and you already know what happens when those parts suddenly get hit with a 25% tariff. It's not pretty. Now GM is in a particularly tough spot because they're in the middle of this massive push into electric vehicles. They're investing billions in developing new EVs, building charging stations, the whole shebang. But EVs are already expensive to produce, and these tariffs are only going to make it worse. Imagine this. GM is trying to convince people to ditch their gas guzzlers and buy electric, but at the same time, the price of their EVs is going up because of these tariffs. I mean, prices will be up all around, but still, investors need to be asking themselves, can GM really afford to absorb these tariff costs while they're trying to ramp up EV production? Okay, so we've talked about cars, but what about something everyone uses every single day? Let's talk about Apple. Apple is a giant in the tech industry, and its products are ubiquitous in our daily lives. Now, Apple loves to talk about how their products are designed in California, but let's be real, those iPhones and MacBooks, they might be designed in the US, but the story doesn't end there. They're mostly made in China. The manufacturing process involves a complex supply chain that spans across multiple countries, but China plays a pivotal role. And when you're talking about an extra 10% on the tariffs that were already there, on pretty much everything coming out of China, that's a significant cost increase for Apple and its consumers. Yeah, Apple's feeling the heat. The company has to navigate these financial pressures while maintaining its market position. Think about it. Apple sells millions of iPhones every quarter. Each sale contributes to their massive revenue stream. Each iPhone has tons of components, many sourced from China. These components are essential for the final product. Now add a 10% tariff on top of that, and you can see how this adds up quickly. The costs can escalate, affecting the overall pricing strategy. They could and most likely will try to pass those costs on to consumers by raising prices, but this is a risky move. Let's be honest, nobody wants to pay $1,500 for a new iPhone. High prices could deter potential buyers. The other option is for Apple to eat the cost of the tariffs themselves. This would mean absorbing the additional expenses, but that would mean lower profit margins, and Apple is all about those juicy margins. Profitability is key for their investors. If this trade war drags on, it could start to have a real impact on their bottom line either way. The long-term effects could be substantial, affecting their financial health and market strategy. Next up, let's lace up our sneakers and talk about Nike. This iconic brand has been a staple in the athletic wear industry for decades, known for its innovative designs and high-quality products. Nike is the king of cool when it comes to athletic wear, but even the king isn't immune to the effects of a trade war. The brand's global reach means it's particularly vulnerable to international economic policies. Just like Apple, Nike manufactures a huge chunk of its products in China. This strategic decision has allowed them to keep production costs low while maintaining high standards of quality. Think about those iconic Air Jordans, those sleek running shoes, those sweat-wicking workout clothes. A lot of that stuff comes from factories in China. These products are not just shoes and clothes, they are symbols of athletic excellence and cultural significance. And when those factories start getting hit with a 10% tariff, guess what? The cost of making those Nikes just went up. This increase in production costs can have a ripple effect throughout the entire supply chain. Now, Nike is a premium brand, so they have a little more wiggle room when it comes to pricing. They can absorb some of the costs, but not indefinitely, and likely not all of them. People are willing to pay a premium for that swoosh logo, right? But there's a limit. Even the most loyal customers might hesitate if prices climb too high. If Nike jacks up prices too much, consumers might start looking for cheaper alternatives. Adidas, Under Armour, even good old-fashioned generic brands. The competition is fierce, and consumers have plenty of options. Nike is aware of this issue, and they've been working on diversifying their supply chain. They're exploring manufacturing options in other countries to mitigate the impact of tariffs. But these things take time, and in the meantime, those tariffs are still in place. The economic landscape is constantly shifting, and companies like Nike must adapt quickly to survive and thrive. Finally, let's talk about a company that's really feeling the turbulence from these tariffs: Boeing. Boeing is the biggest aerospace company in the world, and they build some of the most advanced airplanes out there. But here's the thing, building a plane requires a global supply chain. We're talking parts and materials from all over the world, including Canada, Mexico, and yes, China. Now, when those countries get hit with tariffs, it throws a wrench into the whole operation. Suddenly, the cost of building a Boeing 737 or a Dreamliner just went up. And when your product costs more to build, you have two choices: raise prices or eat the cost. But here's the real kicker. China is also a massive market for Boeing. They buy tons of planes every year to keep up with their growing aviation industry. With these tariffs in place, China might start looking elsewhere for their planes, potentially buying from Airbus, Boeing's European rival. So there you have it. 5 companies that are directly in the crosshairs of these tariffs. Ford and GM are grappling with higher costs for car parts. Apple and Nike are feeling the pressure to raise prices or squeeze their margins. And Boeing is caught in a trade war that could ground their business. The bottom line is this: tariffs create uncertainty and higher costs. And uncertainty is the enemy of the stock market. Investors hate not knowing what's going to happen next, and these tariffs have injected a huge dose of uncertainty into the global economy. So, what should you do? First, don't panic. These companies are all giants in their industries, and they have smart people working to navigate these challenges. Pay attention to the news, listen to what these companies are saying, and be prepared to adjust your investment strategy accordingly. Thanks for watching, and we'll see you in the next video.